mortgage early or invest the extra money that you have, or simply leave the mortgage alone. Now, with the mortgage rates being historically low right now and inflation being really high, the smart thing to do is just leave your mortgage alone, right?
Wrong.
Now, before we dive in, here's a word from our amazing sponsor. Truebill is an all-in-one finance app that I personally use to monitor my credit score, my transaction, and do my budget to make sure that I am not overspending on certain categories. Now that the holiday season is over and you've probably spent a lot of money on gifts and presents for your family and friends, well, now it's time to check on your finances and your budget to make sure you're on target. And it's the New Year's, which means that now is a great opportunity to get your financial goals in order, make sure you set your budgets. So I can do that with Truebill, and make sure you set your goals and budget today by downloading Truebill. The link is down below and also on the screen, so go download your app and try it out for free. Now, there are a few arguments that I hear about why you shouldn't pay off your mortgage early. Now, one of the first arguments I hear all the time is, Sam, you shouldn't have to pay off your mortgage early. Just go and simply take the extra money you have and invest in the stock market where you can potentially earn 8 to 12% return every single year.
Fairy dust. It doesn't exist. It's never landed. It's not real.
The other argument I hear all the time is, well, Sam, because inflation is really high right now, isn't it better to leave your mortgage alone and let inflation pretty much take care of the interest that you pay? And basically the monetary value of the interest that you're paying pretty much erodes and devalues over time with inflation. So stick around to the very end because I'm going to show you exactly what you should do. Pay off your mortgage early or just simply leave it alone. And personally, I probably get dozens of questions every single day, either through our YouTube channel or email about this question of, should you pay off mortgage early or should you simply leave it alone? Well, after helping just over 1,000 people save money and time in paying off their mortgage, as well as getting into investments like real estate, creating millionaires across the country, I think I might be qualified to take a stab at this question. So let me go and tackle the inflation argument first, and then we'll get to the whole, go invest instead argument. So first, the idea that inflation is good for long-term fixed debt comes from the philosophy of investing in bonds. Now, you might be saying, Sam, what does investing in bonds have to do with paying off your mortgage early?
It doesn't make any sense.
Well, when a company or a government body issues out bonds, investors come to buy them. Essentially, it's kind of like investors lending money to these government bodies or companies in exchange for a set amount of interest rate paid back to the investors. However, during a high inflationary environment like what we're in right now, bond investors are pretty much out of luck if they bought bonds, say, last year or 2 years ago. But when we're in a situation like we're in right now at 6% inflation, your 4% yield is pretty much a wash because of the high inflation at 6%. Essentially, you have a negative yield of 2% every year with the high inflation being involved. So in the case of a mortgage, the table has pretty much turned, where you're essentially like the company or the government body that issues out the bond. So when you go and borrow money from the banks at 3 to 4% for the next 30 years, it's kind of like from the bank's perspective that they lended you money at 3 to 4%, inflation's at 6%, so any interest income that they generate from your mortgage is basically a wash because of inflation. But the banks are actually smarter than you think, and they're one step ahead of you.
I wouldn't worry. I've taken millions from them, and they haven't stepped to me yet.
You see, this is where it gets a little bit interesting when it comes to residential mortgages. Banks have pretty much figured out how to take a 3% interest rate mortgage and turn it into a 6, 9, or even 12% mortgage with the following scheme. So guys, let me show you exactly what the banks are doing, turning your 3% interest rate mortgage to a 6 or 9 or 12% interest rate. All right, guys, so what you guys are seeing is called the amortization schedule. All mortgages run on an amortization schedule. No matter what it is, 15-year mortgage, 20-year mortgage, 30-year mortgage, it runs on an amortization. Now, this chart shows you basically how much of your monthly payment is principal versus interest over the next 30 years, of course, if you have a 30-year mortgage. Now, this blue highlighted area represents the interest you pay in proportion to your monthly mortgage payment. Now you notice here that line that goes left to right represents the amount of time you spend in paying off your mortgage. So all the way to the left is your 0-year mark, and all the way to the right is your 30-year mark. So obviously the longer you pay down your mortgage, you're moving to the right. Now the line that goes up and down represents the amount of monthly payment you pay every single month. So let's say, for example, for this hypothetical situation, your monthly payment is, let's say, $1,000 a month. Okay, just as a hypothetical example, just to show you and demonstrate what's going on here. Now, out of the $1,000, you can see in the beginning of your mortgage, if you just got started or you recently refinanced, vast majority of your monthly payment is going towards interest. So just like what I mentioned, this blue highlighted area represents the amount of interest you pay in proportion to your monthly payment, which is $1,000 in this case. The red highlighted area represents the amount of principal you pay down in proportion to your monthly payment. So principal is the actual loan amount. The more principal we pay down, the better. The more equity we build, the more wealth we build. So we want to pay down more principal, okay? We want to avoid paying interest. That is the fee that we pay for borrowing the money. So we don't want to do that. Now, you notice here that vast majority of the interest that you do pay pretty much throughout the whole entire 30 years happens in the first 10 to 15 years in your mortgage. Now, we call this front-loaded interest zone because vast majority of the interest, again, you pay is happening up front of the mortgage. Now, this is where it gets really interesting when it comes to your residential mortgage, and banks have pretty much figured this out. This is why they're okay with lending out 2.5, 3% interest rate mortgage when inflation is at 6%. I mean, like, the banks are not stupid, guys. They figure this game out to where they're gonna constantly make more money off of you, even when the inflation looks the way that it is. Now, guys, I'm gonna go and draw a line on the 10-year mark because this is pretty significant. According to the US Census Bureau data, the average person, the average US adult, is expected to move 11.7 times in their lifetime based on 2010's data. So basically what that means is that if you live to be about 80 years old, you're moving every 7 to 10 years based on the US Census Bureau data. So you might be moving for different reasons, right? You move out of the state, you have a new job across town, maybe your kids move out of the house, so you decide to downsize, or whatever the reason, you may decide to move every 7 to 10 years. Now, if you made it to this far on the 10-year mark on your mortgage, you've been paying a lot of interest thus far, but if you decide to sell your house, move to another area, get a brand new mortgage, get a brand new house, guess what happens? You start all over back to square one with your new mortgage, where essentially your mortgage payment, vast majority of it is going back to interest all over again. Because had you stuck around, had you not moved and got a new mortgage, you would have continued on this journey of eventually getting to the part where you're paying more principal over here. But because you recycled, you reset it, your mortgage amortization schedule, you're going all the way back to square one, where vast majority of your mortgage payment is going back to interest. Now, same is true, even if you don't decide to move. Let's say you decide to refinance. Let's say you decide to refinance into another 30-year mortgage because your mortgage broker or banker says you're gonna get a better deal or better interest rate. Doesn't matter. What happens is if you get a brand new 30-year mortgage, you made it so far into the 10-year mark, you start all over just like getting a brand new mortgage where vast majority of your new refinanced mortgage payment is going towards interest. And friends, this is exactly how the banks have engineered the process using social economic trends, and they know in the next 5 to 10 years you're gonna either refinance or move and basically become a repeat customer, and they know that you haven't made a significant principal pay down on your mortgage, and they know as long as they can keep you in the first 10 years of your mortgage over and over again, they can continue making money even though the interest rates might be really low at 2.5, 3%, or 3.5%. They know if they can keep you recycling, doing this over and over again, that 3% interest rate quickly turns into 6, 9, or 12% interest rate over the time of you being a homeowner for the next 30, 40, 50 years. So guys, as you can see, the banks are playing the long game. They know that every 10 to 15 years, you're gonna recycle, you're gonna reset your amortization. They know as long as they can keep you in the first 10 years of your mortgage over and over, that they can continue making interest over and over again. Guys, you need to understand how the amortization works. You need to understand how the banks make their money, because if you follow the money, you'll know the truth. Not to mention, the real effective interest amount that you pay in your 3% mortgage is more like 60%. And if you don't believe me, just take a look at this calculation I've done with a $100,000 mortgage, 3% interest rate on a 30-year amortization. You'll notice that it's pretty darn close to that 60% number that I just talked about, right? And the very fact that I just explained that vast majority of that is being paid up front in the first 10 to 15 years, that should kind of frighten you a little bit. Now, let's go over to the next argument, which is, well, Sam, why not invest in the markets? Why not go and throw the extra money that you have into the stocks, bonds, or mutual funds, or ETFs, crypto, whatever the case might be, instead of paying off your mortgage early? Because again, why pay off a mortgage at 3% interest rate when we can go and earn 8 to 12% or better in some of the other investments that I can go and throw my money at? Well, I hope my earlier explanation with the whole front-loaded interest zone did a pretty good job setting up for this, because if you're expected to go and live in that first 10 years of your mortgage over and over again, that 3% interest rate mortgage you have doesn't seem so innocent anymore. Basically, the true cost of that 3% interest rate mortgage might be more than just 3%, and it might come neck to neck with the opportunity cost of earning 8 to 12% on a market investment, wherever you want to invest your money in. Because if you're really repeating the first 10 years of your mortgage over and over again, that 3% interest rate becomes very deadly over time. And that's not even factoring the bearish or recessionary times in the market where you actually might see a dip in your returns instead of a gain. And don't get me wrong, guys, I'm not anti-investing. I want you guys to go kill it, grow your portfolio, become multi-billionaires, if that's even possible. Go and kill it. And it's really important to understand how to prevent those things from happening. Don't go and just fill your bucket up with a hole in it. Now, in the beginning of the video, I did mention that you can actually do both, where you can invest and pay off your mortgage at the same exact time. And yes, it is possible. It's not some zero-sum game where you have to choose one or the other. There is a way, a strategy of being able to do both at the exact same time, especially if you're in the game of investing in real estate. In fact, this is exactly what my clients and students of our coaching programs are doing to basically pay off their mortgage and invest and grow their portfolio over a long period of time. So if you want that secret, go and click on this video right here. We're gonna show you how to pay off your mortgage and invest at the exact same time. That way you're protecting your downside as well as increasing your upside of creating profit, your wealth, and investment. So guys, that being said, now go make millions and Brazilians.